anywhere. And the stream just crashed. Are you effing kidding me? This video then. Man, that is super annoying. So let's, maybe I'll go through them again. We're looking at reversal patterns, 3 basic reversal patterns. This time you'll be able to see them, I hope. Wow, I'm just happy the computer didn't crash, man, because everything went black a little bit ago, and usually that means that it crashed. So here, the first... oh yeah. The first pattern that we looked at, and I just talked about, but we're going to go over again, is called a double top. A double top is signified by a rally that sets a high, pulls back, rallies again to the same price level, and rejects. This is a powerful reversal signal because it shows that the market is not ready or able to pass a certain high. The opposite and upside down version of this is called a double bottom. It's signified by sellers pushing the price down to a low, a slight rally, pull down to the same price value low, and bouncing off. And this is the bullish version of the double top. And this is bullish because it shows that sellers are maybe exhausted, unable to bring the price down lower than previously, and that buyers may resume control or reverse control, because we're looking at reversals. So double top, double bottom, that's the first and simplest reversal sign. So number 2, we have the head and shoulders. A rally followed by a pullback, a higher high, pulls back again, rallies to a lower high, and then sells off. So this is a head and shoulders because it looks like a head and shoulders. So we've adopted that name. What's most important about this this pattern and identifying it, because really, if you don't have the right shoulder here, lots of things can look like this, and you can always be assuming that a head and shoulders is coming. So what we need to verify or validate a head and shoulders is what's called the neckline. The neckline is created between the left shoulder here and the right shoulder. And to have a valid head and shoulders pattern, the right shoulder, where it begins, needs to actually make a lower low than the left shoulder. If it fails to make a lower low and break through this neckline, then we could be looking at a potential double bottom. And that's why breaking is important. That's why setting a lower low on the right side is important. What to expect in a head and shoulders pattern is once that low is broken, to see a relief rally that sets a lower high than the head, being the middle part of the structure. A rally and a sell-off. So head and shoulders are, in my opinion, the most dependable pattern for reversal in crypto specifically, but in all markets. They really do play out a very large percent of the time in comparison to a lot of the different patterns and signals, indicators that we usually take a look at. And that's why it's very important. And so a head and shoulders is a bearish, a reversal from a bullish rally into potentially a bearish sell-off. And in the inverse, the opposite version of this is called an inverse head and shoulders. Sometimes written IHNS. And it's the exact same setup, except upside down. We have sellers bringing price to a low, a relief rally, a sell-off to a lower low, a rally back, And just like how the head and shoulders needed to have the right shoulder have a lower low than the left shoulder, in inverse head and shoulders, the same is true, except the right shoulder has to have a higher high. That's rejected. And then price moves back up. So again, we have the neckline. We have the neckline created by the left and right shoulders printing. And once price on the right shoulder here pulls back again and breaks through the neckline, that's where we would look to see a reversal. We have the same is true on the inverse head and shoulders. It's validated by the right shoulder making either a lower low or higher high in comparison to the left shoulder. And as the right shoulder completes, we look for that high again to be broken, or the low, and that is where the reversal can happen. So that's where a trader may look to go long in an inverse head and shoulders, or look to go short on a head and shoulders. So the final pattern we're going to look at today doodle these out for you. The final pattern we're going to look at today, and we see these a lot in crypto, and potentially we're looking at one currently in price action on the daily, is an ascending and a descending wedge. So ascending wedge is characterized by a move up that sets higher highs and higher lows consecutively. Could look something like this. But what's important is that the highs are coming up, the lows are coming up, and price is coiling. Price is compressing. There's less volatility. And so what we can expect here is ascending wedges typically or statistically more often break down. So the signal here to follow for an ascending wedge would be when the higher lows, when the string of higher lows is broken, trader may look to go short as soon as the ascending wedge fails to make a higher low. Statistically, I would say about 55% of the time, maybe to 60%, ascending wedges break down. So higher highs, higher lows, and the signal for this is when the higher lows fails, typically then you'll see a continuation sell-off. The bullish version of this reversal pattern is called a descending wedge, which is, you guessed it, the upside down version of the ascending wedge, characterized by lower highs and lower lows. And the signal for a trader would be when price breaks out of this compression and manages to set its first higher high out of the wedge, the trader may look to go long. Typically, these are very dependable as well, maybe not quite as dependable as a head and shoulders pattern, but there's something that we see often in crypto and markets in general. And what's nice about these reversal patterns is each one has a defined point or a set of definitions that we can measure. So in an ascending wedge, we see the higher low broken. That is a signal for us to go short. In a descending wedge, the lower high string is broken, signal to go long. Double top and bottom, easy because it's just the price hits the same point twice and is unable to pass. And head and shoulders with the validation of the right shoulder, once that area of price is broken, is usually a good signal to follow the trend in the reversal there. So they're very concrete in the sense that they have defined points where traders can look to take a position. So that was ridiculous with the computer going down and not having the right scene thing happen. Whatever. But hopefully this helps.